Lending-based crowdfunding is a direct alternative to a bank loan with the difference that instead of borrowing from a single source, you can borrow directly from several individuals. This is why it is usually referred to as peer-to-peer lending. It is the platform that matches lenders with borrowers and that helps in setting the interest rates offered. It is a market now larger than 30 billion euro that offers two different business models. Similarly to a bank, a crowdfunding platform can distribute at its discretion the money received from several lenders, spreading it on a number of different borrowers. In this way, the risk is distributed on several investments in a portfolio logic. The industry figures show a very low default rate and low volatility against an interesting rate. Moreover, lenders do not spend money or time in scouting and due diligence. Under the second model, instead, you decide to which borrower you want to lend your money. You may be directly engaged and evaluate the projects of the borrowers, which is very typical of crowdfunding dynamics. It's fun, it's social, it's engaging. It's a kind of gamification that is meeting a large interest from the crowd. Besides the business model, you can choose either generalist platforms that offer lending on a number of different businesses or vertical platform specialized in a single market. Vertical models are more usual for direct lending platforms, where you can choose your borrowers. Some platforms are specialized in real estate, other in energy or other businesses. So to aggregate opportunities in specific areas where certain investors may feel more comfortable to deal with, either for their interest or personal knowledge. The loan size and the interest rates can vary greatly, so can cater for most needs. Market data demonstrate that investors are interested in any kind of loan, either for private or business purposes. The market is also evolving so to offer different opportunities to different clusters of lenders, either retail, high net worth individuals, or institutions, shaping loans to meet their requirements. The platforms manage the entire process, from the scouting and the due diligence of the borrowers to the distribution of the proceeds to each lender. Therefore, the service of the platforms involves either investments and money transfers, which are heavily regulated topics in Europe. While some member states apply the current financial service framework to crowdfunding services providers, others allow them to stay outside the regulatory regime with operating under exemptions. The dynamic nature of business models and different interpretation of existing European legislation across member states has led to a large variety of regulatory frameworks for crowdfunding service providers, ranging from no regulation to strict application of investor protection rules. To date, some member states have introduced national bespoke regimes for crowdfunding, while others require crowdfunding platforms to get licensed and operate under existing European frameworks, such as the MiFID and the Payment Service Directive, the PSD2. In most countries, strict regulation mostly depends on the fact that lending platforms be directly involved with the transfer of money. Platforms that directly take care of money transfers among lenders and borrowers have to be authorized to operate as banks or payment institutions and to be compliant with the PSD2. Otherwise, platforms may operate as payment agents in connection with licensed banks or payment institutions, which take care of the compliance. This means that lenders might have to open two separate contracts at once, one with the platform and one with the payment institution, which is responsible for the opening and management of their digital wallet and for the money transfer. As a consequence, also anti-money laundering obligations might be differently distributed among platforms and their licensed partners. In any case, platforms are investment venues that have to be very clear with the crowd when offering lending opportunities. They have to be transparent, to inform investors about the risk of investing, and to make it clear that the platform is not the borrower. Any loan is directly stipulated with a company or an individual, who is the only subject liable for the full repayment of the debt. It is self-evident that large differences in regulatory standards prevent crowdfunding platforms from scaling their operations across the European Union. Their business models would have to be adjusted according to each jurisdiction, would require multiple national authorization or registration, and compliance with divergent national laws. This results in high cost, legal complexity, and market fragmentation, as well as a lack of economies of scale and inconsistent approaches to transparency and financial risks. Though provision of crowdfunding services has not been subject so far to a targeted European Union action, now finally the European Commission is working to help investors and businesses to seize the potential of crowdfunding and make it easier for platforms to offer their services throughout Europe. In May 2019, the European Parliament is expected to vote on a proposal for a regulation offering a common European framework to lending platforms operating for business borrowers.